there's been a lot of crazy stuff as far as like meme stocks, like AMC and GameStop, and a lot of people, think that they're being like revolutionists, but then you have a lot of people that also think like the entire system's like rigged against them and stuff like that. So I was curious, like, what your thoughts were about that, like when all of that was unfolding.
Yeah, I mean, I think this is another case where history is just repeating itself. Like you saw this in the 2000 era. Um, uh, basically, there were cab drivers buying .com stocks. I remember a .com I was shorting called MP3.com. If anybody remembers that old one, I mean, there are hundreds of these kind of. They weren't memes necessarily, but they were sort of pathetic early businesses. And I think I see Mark in the chat, and there were a lot of people like I think I read his colleague Ben's book about the stress of like having open wave and during like one of those issues where the markets were like closing down and stuff like that, and PayPal had a similar sort of crisis. So I think this is just a time where it's healthy for the market to separate winners from losers. And like I said sort of earlier, like in the markets, you're going to get tested, whether you're an investor or a company or whatever. And I was really delighted to talk to, I mentioned one of the biggest privately held software company CEOs earlier today. And, he happens to have overraised, kind of an enormous amount of VC cash. And he's going to be sitting pretty, like being able to pick off whatever company he wants during this downturn. And those who did smaller rounds won't. And because there aren't going to be any more rounds. There's going to be a lot of issues. Like, I don't think, you know, VCs won't be able to raise money fairly shortly. And after sort of some of the early returns come in, I think there's going to be another winter for many years, possibly. And you basically have to toughen out and relax. I'm sorry, toughen out and be able to withstand through these cycles. And I don't know, like, I, I think the meme stocks were sort of emblematic of sort of easy money and rising valuations. Like obviously GameStop is overvalued and AMC is overvalued. And this phenomenon where people would actually bid up a stock as a retaliatory, kind of mechanism is sort of bizarre. And it's like a very Freudian or like, I don't know, psychologically interesting phenomenon, but it's crazy. You do have this George Soros spoke about this concept of reflexivity, which is his invented idea that not only do stock prices affected by news, but prices can affect news itself, which is a very bizarre idea and kind of hard to wrap your head around. But the whole idea of GameStop going up and then becoming a better company because its stock price has gone up is a really wild idea. And I don't think reflexivity is really strong enough to sustain that. Like, even though they have a better CEO and a better management team and more access to capital markets, like, I don't think that it's likely that you can turn sort of a bad company into a great company just because you want to will it to get there. And the same thing applies obviously to AMC or any other quote unquote meme stock. So I think those people are just making errors in their investing. And I tried to point that out as one of the forefathers of Wall Street bets. But I think it's also, it's fun for people to sort of, strike back at the empire, if you will, and kind of have fun, with a stock. But, the market's not a game. This great book about Wall Street, the history of Wall Street, it's called The Great Game. And it's by uh, John Gordon Steele, I think. And so, in any way, it goes to the history of Wall Street, which a lot of people don't know, all the way back to the Button Wood Agreement and Wall Street started. And one of the fascinating things is that there were these things called corners. And this is what led to the creation of the SEC and 13D and 13G rules, which people sometimes follow and sometimes don't. But the idea is that, once you own 5% of a company, you have to disclose that you own 5% of a company, which is all well known to any big investor. And there are certain rules on further disclosures after other levels like 10%. And so there's even more rules after that. But the point is that you can't buy up stock in a company and then sort of corner it. And this is, in fact, in the 20s, there was this huge drama between people like Cornelius Vanderbilt and others, where they would corner these stocks and they would kind of do what the Wall Street Bets crowd did. And they made it illegal to do so because it really distorts and fucks up the market. But in the past, it was just one person who would do it. Someone like Cornelius Vanderbilt, who was super rich, and he would buy all the stock, and then people would short it, and then he'd call in that stock that they shorted, and it would cause this amazing panic. And it was really funny and probably pretty awesome to do. So the SEC was created, and this stuff didn't happen again. If you tried to do it in other opaque ways, it was called wolf packing, and wolf packing was made illegal. So then you had to form a group if you had to disclose that you were acting in concert with another investor. So all that stuff happened. But now with Wall Street Bets, we have a distributed corner, right? Because there's no group, and everyone owns 1,000 shares or something. Some people own more, some people own less. But you basically have a distributed, decentralized corner on a stock. And it obviously had an impact. I mean, GameStop went from whatever 4 to 400, and it took out a hedge fund or two on the way up, and it's amazing, you know. And corners kind of work because they're almost like in game theory, like almost like a game of chicken. You know, the short seller only has finite capital. The long guys also only have finite capital, but the long guys get margin on the way up, and the short guys lose margin on the way up. So you know, corners can really destroy heavily shorted stocks, and that's what happened with GameStop. And that's why corners are illegal. And we also know this from Nelson Hunt and his corner of the silver markets also created new laws in the CFTC trading for futures. So if you guys don't know, in the 70s, the Hunt brothers tried to corner all the silver, and they did, and they forced the price of silver up to astronomical levels. So if this doesn't sound familiar, you know, that's the history of it. And you know, the CFTC was created, and they changed the margin rules, and they changed the requirements on silver. Silver plummeted, and the Hunts actually filed for bankruptcy. So that's how that ended. And I think it's going to be hard for the SEC to make a rule that you can't buy stock that you read on a message board. So I think it'll probably happen again, and maybe even again and again. But it's a really weird and funny circumstance, and I don't know how it'll shake out, obviously. But I think that it's obviously short-sighted, and it's sort of a game. It sort of makes the market a game when these stocks go parabolic, and you just don't know when the musical chairs will end. But at the same time, it's almost, again, a shock that a portfolio should be able to withstand. It's hard to short a stock that goes from 4 to 400. I mean, if you're short 1%, it would take your whole portfolio to zero. Hopefully, you have some risk control to get out at 12 or 18 or something. But obviously, these really smart hedge funds, some of these guys I know pretty well, and they all got smoked shorting the stock. So it's not easy to design a portfolio that can withstand something like that. And it'll be really interesting to see how regulators kind of try to figure out how to stop something like GameStop from happening in the future. It'll be really interesting to see how degenerates like myself and Wall Street Bets try to ensure that it continues. So that's how I'd answer that one.